What I have for you today is the Court of Justice of the EU decision in state aid between Fiat Chrysler Finance Europe and the European Commission. But I want to look at the transfer pricing aspects of this case, not the EU law aspects. And quite frankly, it has been one of the more difficult videos to prepare just to try and find the relevant facts from that perspective. So we start with the statement of the European Commission from Margarethe Vestager after the Commission lost the case before the Court of Justice, and she mentions that Fiat Chrysler saved at least 30 million euros in tax since 2012. Not a huge amount considering the amount of resources that went into this case. Then there is the decision from the European Court of Justice, or the Court of Justice of the EU as it's now called now, from 8 November 22, in which it basically rejects all the Commission's complaints. There is the opinion from the Advocate General, which actually said that the Commission should have won, because the Advocate General also had the judgment from the General Court of the EU, which look at state aid cases in first instance, which basically said that the Commission were right on all points, and therefore Fiat Chrysler should have repaid the 30 million that it saved in taxes with interest. And then there are the European Commission decisions from 2015, which was the final decision, and its original opening statement, in which it said, it's investigating the Fiat Chrysler ruling for the following reasons. So let's look further into this case from a TP point of view, and this is what I want to do. I want to answer the following questions. One, what was the facts? How does the group structure look, and how did the transaction stream look, right? Two, how was Fiat's profit calculated? Because that's obviously what's interesting for us from a TP point of view. How should it have been calculated, at least according to the Commission? Why was the Commission unhappy with the way Fiat calculated its profit? And then this is the difficult part of this decision. Where did the difference go to, and what was the savings? Because if the difference didn't go anywhere and there were not any real savings, what is the problem? The Commission already said there's savings of 30 million, but how does that work out? Then we need to look at what the General Court said. Why did they agree with the Commission? What did the Advocate General say? And then finally, what did the Court of Justice say? And it's important to split these out, because Fiat Chrysler wins on one argument, and the other four arguments are not really, or three arguments are not answered by the Court of Justice of the EU, which means that, the fact that the Advocate General agreed with the Commission and the General Court agreed with the Commission means that there might be some substance in what the Commission said that is valid, and those points, for our purpose, actually really address the TP question. So the question is, where does this leave us now for TP purposes? A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. So let us look at the group structure and the transaction stream. So here you can see this is the structure as described by the Commission. It's more the transaction stream than anything else, but you had Fiat International obviously at the top, and then you also had Fiat Finance FFT in Luxembourg, and this is the company which is the target of the state aid case, right? You have FFA, which is another group finance company in the US. You had FFC, which was for a group finance company for Canada, and then you had FF SPA for Italy, which was a group finance company for Italy alone. And Luxembourg financed all the European companies except for the Italian companies. So the Commission describes in their 2015 report where they said that they're starting the state aid case. They said the treasury companies are organized as follows. Fiat Finance SPA, we see here in the bottom right, is the Italian-based treasury company in charge of coordination of the finance operation for the Fiat Group companies based in Italy. FFT performs treasury functions for Fiat Group companies based in Europe, excluding Italy, and then you've got North America. And North America is brought into the picture here because, as you can see here, the way that the finance streams worked within the group was both FF&A in North America and FFT in Luxembourg got finance from the market, right? And then FF&A would lend money to FFT, but you can see from the picture at the top that was a stream of loans going both ways. And then FFT would lend that money to the different Italian group companies, and you see here at the bottom they had deposits, short-term borrowing and long-term borrowing, and then they also had FF, to which FFT would lend money as well. And the Commission then says in 305, and we come to what is the TP issue here, right? In 305. A comparison of the declared profitability of FF in Italy and FFT indicates the difference in profits between FF and FFT. FF is the most important counterparty of FFT, so a lot of money went to FF because that's where Fiat is situated, right? Which sources funding on the market and passes part of the funding to FF, which in turn lends it to Italian companies of the Fiat group. Fiat's internal transfer pricing policy document seems to aim at remunerating both companies, so FF and FFT, with similar returns. However, if we look at the actual returns on equity recorded and subject to taxation at the level of the two companies, FF is much higher than FFT. And here is the crux of the matter, right? Now the first issue that's raised here is it appropriate to compare return on equities between the two companies? But that is quite honestly, that is what basically FFT did in its transfer pricing policy. It calculated a large part of its income on return on equity. So we can see for FF in Italy, the return on equity was 6.4, 9.4, 9.1, and 4.1 over the different financial years. Whereas for FFT in Luxembourg, it was a 10th or even to 15th of that for those same years. And the question is, how can you explain the difference? I'm just moving the text from the bottom to the top here because the Commission raises a second issue, and that is that they say, to determine an appropriate return on equity to apply to FFT's accounting equity, the aggregate statistics from the banking sector seems more adequate than a set of 66 financial companies, which seem in large part to engage in specific financial activities. So what happened was FFT and their tax advisor looked at some financial companies, they made a list and they said, look, we're within the range. And the Commission says, yeah, but you're not, it's the wrong range, right? You need to look at yourself more like you look at banks. And you need to look at what the return of equity on banks are. And this is not completely wrong, because when it suits them, the tax advisors and FFT also use the Basel rules for minimum equity requirements and issues like that to determine what is the equity that FFT should have, right? So the Commission then says, now let's see how much banks have earned. And they said, as mentioned in recital 304, it's above here, the currently required return on equity for European banks is around 10%, a level which has been maintained even during the financial crisis. In fact, information from the time of the contested tax ruling confirms that the level required return on equity, for example, according to the Bank of International Settlements publication of 2011, over a longer time horizon, financial firms have tended to achieve return on equities of 11 to 12%. Now, the Commission then mentions two more studies, or three, which also are in a range of 10 to 12%, at least above 10%. And the Commission just says, you making 0.6, 0.6, 0.4, and banks are making 10%. Therefore, we say that your arm's length, even if it's in accordance with the ruling, is not at arm's length as the OECD has intended it. So let us see how the calculation was made for FTT's profit. And you can see in the top left here, it comes from the Commission paper of 2015, which was a Commission decision on state aid, right? If we look at the bottom right here, you can see the statutory financial statements of FTT for 2009, 10, and 11. You can see they had an equity in their financial accounts of 293 million, 285 million, 287 million, 200 and 2011. And then they had some intragroup debt, they had some third-party debt, a lot more than intergroup debt. The intergroup debt would have been to Fiat North America, one would assume, and then this was their total liabilities. Now, if we look at how they calculated the tax in their return based on the ruling that they got from the Luxembourg tax authorities, they calculated the minimum capital requirement that FTT had, and these are thousands of euros. They said FTT had an operational risk of 938,000, one would assume, right? And A, as you can see here, was 15% of the financial revenues on this bank deposit minus the financial charges on its bank loan. So that was one part of the capital that it needed. It also had counterparty risk of 2.6 million, which was 20% of 6% of the future exposure plus the positive fair value of derivatives with third parties. I'm not going to go into details of what this means and how it was calculated, but that was part of their calculation. And the reason why I don't go into a lot of the details here is because A, the video would be extremely long. B, I do think it'll be fair to say that a lot of this calculation was result oriented and some hocus pocus. The advisors are welcome to disagree with me, but that is my point of view on this. C, in an interesting one, it said that FTT had no currency exchange risk because 100% of its currency risk was covered by derivatives. So that was completely obliterated. One could have thought that they could have said, well, listen, most of the loans are euro to euro because it's from Luxembourg to Italy, but maybe there were dollar loans coming in to Luxembourg. I'm not sure. The credit risk was calculated as 25 million effectively, and as we say, D here is this 20% times 6% plus the account receivables with third parties, and that brings us to a minimum capital requirement of 28.5 million. Now the total real equity is 287 million, but there's 28.5 million. So what do we do with the rest? Well, FTT said that, some of our capital is invested in participations. We take that out because I assume the argument is there we get dividends, we don't get a risk premium. And then what is not invested in participations, the way I read the case is excess capital, and for that we should get a compensation. And the compensation here is equal to G minus E minus X, and G is your equity minus your minimum capital requirement minus the amounts invested in subsidiaries. So that is the amount that needs to be compensated on excess capital basis. And then they say, if you look at the net profit indicators for these different amounts, the expected return on capital is 6.5%, and that is what we will apply to this minimum required capital of 28.5 million, and then the short-term interest rate is 0.87%, and that ultimately gets applied to the excess capital, which is in short-term loans and stuff like that. And you can see that in this table here, right? So the risk remuneration for 100 to 2 million to 200 million is K, which is H multiplied by E, so it's 6.5% times the minimum capital requirement, and then the functions remuneration, in other words, well, again, for capital that was not invested, right, is J, which is I times F, so it's a 0.8% multiplied by the excess capital, which is then deemed to be used for the functions remuneration. So the total earnings before profit should be 2.5 million, and that is also what they before tax is what they reported in their tax returns. But again, you can see this is very heavily dependent on the fact that the minimum capital requirement is 28 million instead of the real capital of 287 million, and then that the expected return on capital is 6% instead of this more than 10% that the Commission was talking about before, right? And some of it is even based on 0.87%. And all of this, again, is possible because of the difference between the minimum capital requirement that's used for calculating the FTT's taxes, as opposed to their real equity, which is 287 million. So